A community organization starts with a modest grant and volunteers. 5 years later, paid staff, $500,000 revenue, multiple funding streams. The operations have scaled, but the board still runs the financial governance the way they did when the organization fit in a shoebox. The failure point arrives when a funder or the taxation office asks for evidence of tax status, and the board realizes their internal governance hasn't evolved alongside their growth. To understand why this happens, we have to look at the foundational legal axiom in Australia. Not-for-profit is a governing purpose. It is not an inherent regulatory tax category. The label simply describes your constitution. It means your governing documents contain a non-distribution clause, preventing you from operating for the profit of your members, and a specific winding-up clause for when the entity closes. Those clauses qualify you as a not-for-profit, but they grant exactly 0 automatic tax concessions. Assuming the label alone protects your revenue leaves the organization financially exposed. The Australian tax system offers generous concessions to the sector, but they are highly conditional. They are legal positions that must be maintained, not a permanent status you're handed once. Tax compliance for these organizations is an active, structural framework. Properly managed entities pay very little tax because they continuously substantiate and defend their legal right to that exemption. Without this active defense framework, a growing organization is structurally vulnerable to administrative failure and financial liability. This decision tree outlines the primary regulatory paths every scaling NFP must navigate. The landscape splits immediately into 2 distinct avenues: charities on the left and non-charity not-for-profits on the right. Organizations on the left path must explicitly prove their specific charitable purpose. For these entities, registration with the Australian Charities and Not-for-Profits Commission is the mandatory prerequisite. This registration serves as the verification point before the ATL will grant charity-specific tax concessions. The right path represents non-charitable not-for-profits, such as community sports clubs or social groups. These entities skip the ACNC and deal directly with the ATO. Starting in the 2023-24 income year, these entities face a new compliance requirement. They must lodge a mandatory NSP self-review return with the ATO every year to confirm their income tax exemption. Misidentifying which of these 2 paths an organization belongs to makes any subsequent tax claims legally invalid. Once you establish the correct regulatory path, 4 primary tax concessions are available. We can map these as a 4-quadrant matrix. First is the income tax exemption. Charities require ATO endorsement to secure this, while self-assessing NFPs must lodge their annual self-review return to maintain it. Second is GST. While the standard business registration threshold is $75,000, not-for-profits have a higher threshold of $150,000 in turnover. Third is the fringe benefits tax. Specific entities can access FBT exemptions or rebates up to a capped grossed-up value per employee. This allows organizations to offer salary packaging and compete for qualified staff. The final quadrant is deductible gift recipient status. This allows donors to claim a tax deduction for their gifts, but it is the most misunderstood area of NFP law. Charity registration does not automatically result in DGR status. These are separate legal endorsements with different eligibility criteria and distinct application processes. Treating these 4 concessions as a single package rather than distinct legal categories is a common path to an ATO audit. To manage your revenue correctly, you must apply the mutuality principle. This legal concept states that an organization cannot derive taxable income from itself. This principle must be physically mapped into your financial software. Your chart of accounts should act as a filter that automatically segregates incoming funds. Money received from your own members for member purposes, like subscriptions and levies, are mutual receipts. These are non-assessable and tax-free. Money from non-members, such as external venue hire or investment income, are non-mutual receipts. These are assessable and generally taxable. If you fail to separate these categories in your initial chart of accounts, your internal revenue and external income become an indistinguishable taxable mess. A poorly structured chart of accounts invalidates your tax-exempt defense by making it impossible to substantiate which funds are actually mutual. It is a mistake to think that being income tax exempt means you are exempt from other employer obligations. Not-for-profits carry the exact same duties as any commercial employer. You must manage PAYG withholding, state payroll taxes, and single-touch payroll reporting for every pay run. You also carry the superannuation guarantee, with the rate reaching 12% from July 1, 2025. If your administration is disorganized and superannuation is paid late, it is not tax-deductible. This creates a compounding financial penalty that your mission cannot shield you from. Growth brings standard corporate liabilities. Your status as an NFP provides no legal leniency for failing to meet these employer duties. Organizational growth and success are often the primary risk factors for compliance. Scaling your revenue silently triggers legal requirements you may not be prepared for. Consider an organization successfully scaling its revenue over a 5-year timeline. The first tripwire is the GST threshold. You cross the $150,000 line because of a single large grant or event, and if you miss the registration deadline, you create backdated liabilities for the entire organization. The second tripwire is commercial activity drift. Opening a cafe or a training arm might generate cash, but if those activities aren't related to your core mission, they can jeopardize your exempt status. Then there is DGR scope creep. DGR endorsements are tied to very specific funds. Using those funds loosely for general operations is a direct breach of your endorsement. Growth also increases related party risk. If you pay a company owned by a board member, that transaction must be at arm's length, disclosed, and documented. As the organization expands, it often outgrows the constitution that qualified it for concessions years ago, breaking the foundational compliance structure from the inside out. The board can mitigate these risks by converting the entire tax matrix into a rigorous compliance calendar. You establish a short-term rhythm, monthly or quarterly activity statements for GST and PAYG, STP reporting every pay run, and superannuation paid strictly by the due date. The long-term rhythm includes the annual self-review return, the FBT year ending March 31st, and for charities, the ACNC Annual Information Statement. This annual information statement is a critical point of failure. If you fail to lodge it for 2 years in a row, the ACNC will revoke your registration. That revocation leads to a disastrous cascade. You immediately lose your charity status, your DGR endorsement, and every associated tax concession. To prevent this, substantiation is your only defense. Maintain a central register of your tax status, your ABN, your exact basis for income tax exemption, and the specific scope of your DGR endorsements. Review this register annually, and trigger a professional review whenever the organization begins a materially new activity. By building this framework and calendaring your obligations, tax compliance moves from being an existential threat to invisible background hygiene. You defend the right to pay little tax by proving you meet the conditions to do so.